But so on this session, we have Mike Appleby at Liontrust, Ben Constable-Maxwell at M&G, sorry, getting late in the day. BNY Mellon, we have Andrew Parry. Pictet, we have Dr. Steve Friedman. So thank you all very much for joining me. And I appreciate you taking the time. I will try not to go into babble mode too much. This is my fourth panel. You might have to help me out here a bit here, guys. And I know you're well enough to know that you will. So it gives me great pleasure to bring you guys on board for this session. It's really important that we help people to understand both the idea of impact and positive impacts, and the fact that it's not that straightforward. You can't always very easily prove when something's a positive impact. Sometimes we've got to just do what seems like the right thing and may not have all the numbers to hand. But the flip side to that, of course, is that some people are seriously greenwashing people, which cannot be allowed to continue. We talked on that with the regulator earlier. And I would like to now obviously discuss with you the questions that I put to you ahead of the event. So, hello, I can see you all back again, which is a good thing. So if you would like to first start by all introducing yourselves briefly, we've got 40 minutes. I've suggested questions for all of you, but if you want to jump in, and I know you've all got loads to say on all of these, but do wave at me, do say if you'd like to add, and I'll try and remember to bring people in. First off, though, obviously for everybody, if you'd like to introduce yourselves, maybe Mike, would you like to kick off?
Yes, thank you very much, Julia. Good afternoon, I'm Mike Appleby. I'm an investment manager and I work at Liontrust, and I'm part of the investment team that run the Sustainable Future Funds. My job is essentially to find sustainable companies to invest in that will outperform the market because they're delivering products and services that we need more of to develop in a more sustainable way.
Thank you, Mike. Ben, would you like to introduce yourself?
Yeah, thanks, Julia. Can I just check, can you hear me okay?
Yes, absolutely.
Good, great. So yeah, Ben Constable-Maxwell. And I work at M&G. I've been at M&G for kind of 18 years or so, working in ESG for the last 10 years or so. And my role is to help develop, in particular, our sustainable and impact program across asset classes. And I work in particularly on our listed equities impact fund. But I try and work with our sustainability and analyst teams in embedding sustainable and impact considerations across our investments.
Thank you. And sorry for getting your company name wrong. I was about to introduce you as BCM there as opposed to M&G, which is just late in the day. It's not good.
No problem.
Andrew, perhaps you'd like to introduce yourself, please.
I think you're doing rather well, actually, after such a long day. Hi, I'm Andrew Parry. I'm Head of Sustainable Investment at Newton Investment Management, one of the investment subsidiaries of BNY Mellon Investment Management. I'm responsible for the development of the sustainable product suite at Newton, as well as the responsible investment team. We've been integrating ESG for over 15 years, engaging with companies for 20 years, and I've been hanging about in the investment industry now for 35 years, and about a third of which has been in ESG, sustainable or impactful investment.
Thank you, Andrew. And Steve, would you like to introduce yourself, please?
Absolutely. I'm Steve Friedman. I'm with Pictet Asset Management in our thematic equities business, where I am a product specialist focusing on our environmental strategies, so environmental solutions, clean energy types of portfolios. I've been in the ESG space for the last 6 years, previously more on the wealth management side of the industry.
Thank you.
You're the only person in an office as well.
I'm in an office, but I had to pin white stuff to the wall to make it look less cluttered. But yes, the offices do still exist, evidently. Wow. Yes, thank you, Steve. So next comment then. I want to start by asking all of you, can you just start by defining positive impacts and outcomes? It's a phrase that we all use a lot. Those kind of words get bandied around, and my fear is it's become a bit narrow, and actually I want people to understand everything has an impact. That's one of my takes on this. And then also touch on, while you're doing that, what do you do to help encourage positive impacts, help deliver positive impacts? Who shall I start with? Shall I start with Steve on this one? I'll do reverse order this time, shall I?
Sure. I mean, yeah, I think that just the backdrop to this discussion, ultimately, and here we're talking about listed market investments, is that the narrowly defined impact investment industry and private markets is just way too small to be able to fund the funding gap for, let's say, the sustainable development goals, right? What we're talking about, the shortfall of $2.5 trillion per year, according to UNCTAD, and the GIN estimates that the size of the impact investment industry, narrowly defined, is under $1 trillion. So we need to deploy capital at scale through listed markets. Of course, it's more complicated. The whole concept of impact is a bit more fuzzy if you're not directly investing in privately held companies. But for us here, we're just adopting standard definitions from the GIN, the Global Impact Investment Network. For something to be considered an impact investment, you need two things. Which is, number one, you need intentionality. You need to have a clear intention in terms of how your investments are driving positive change. Typically, you have some theory of change, sort of concept borrowed from philanthropy that explains that link. And the second element is you need to be accountable for the impact, right? If you're basically stating that there's a double bottom line, financial return and non-financial return or impact, then the financial side, you're accountable, always been. On the impact side, you have to be able to document the progress. So basically, impact measurement becomes a key element. And those two concepts can be applied to listed equities, and which is how we think of it in the thematic space.
Thank you. Brilliant. Andrew, can I ask you? I'm going to do reverse order. So, Andrew, next, please. How do you define it, and how do you go about helping to deliver positive outcomes and impacts?
Yeah, well, I think Steve was right in using the GIN definition, for impact. But I tend to think of it in, forgive me for being sort of pedantic on the use of English here, but I tend to think of impact with a capital I, impacts that all companies have, and being impactful. And so, impact investing, which has a very rich history, there's a term coined by the Rockefeller Foundation way back in 2007, and was a way of really scaling philanthropy through the use of financial discipline to give longevity and scale to the impact through a financial discipline. So it was that classic definition of an intended and measurable social and environmental outcome alongside a financial return. Now, that financial return did not have to be a market rate of return, but as Steve said, intentionality and additionality were the sort of core elements of that. And I think that's still the beating heart of impact, where there's something extra that's being applied, whether it be capital or an intervention to deliver a better social or environmental outcome. I think impacts are the social and environmental consequences that all our investments have, both positive and negative. And for me, in public equities, I think the clear and transparent reporting of those and reporting negatives alongside positives is a really important element of avoiding greenwashing, but really elevating the debate. If we spend too long actually on just focusing on positives and never acknowledge that we're in deficit environmentally at the moment, we've crossed 3 planetary boundaries out of the 9. We've got probably a few that are about to be crossed as well. Then I don't think that's helpful. So I think you have to have that balance. And then I think I'd always describe in public markets, it's impactful investing. You've got to be careful about not mixing up first order and second order effects. So we're investing in the companies that are having the impact. And I think then again, you have to be very careful about measuring the degree of intentionality and the balance in the business. Because it's important, would that activity exist anyway without that company being in existence? So what are they bringing over and above the normal economic activity wouldn't bring? Yep. So if Ecolab didn't exist, probably hand sanitation would continue to be done. So I think it's about trying to put a very high bar in public equities. I think it can frame growth opportunities, but just remember that beating heart of impact from way back in 2007.
Absolutely. Ben, I'm guessing you'd like to build on that.
Yeah. Well, no, I mean, I think the kind of four mentioned characteristics, are very aligned with what we would think, Julia. But I think the challenge is identifying sort of truly impactful companies, and then thinking about how that equates to impact in investing. I completely agree that we need to take a holistic approach about not just sort of cherry picking the sort of selected positive impacts that a company or a portfolio might have. I think you have to do a really forensic, sort of holistic assessment of all the impacts an investment has, and aggregate those across the portfolio as well. So I think our view is that a net impact assessment is really important. I do think you can. The question of, and we've got into it sort of pretty quickly, the question of additionality in public markets is a really interesting one, and I think we try and think about additionality and actually all the principles of impact on two levels. One, the level, the analysis at the company level, so the investee level. In the context of additionality, is this company doing something special? As Andrew says, if the company were removed, would the challenge be less well dealt with in a material, sort of notable way? And I think that's about whether the company is bringing something innovative, sort of at particular scale, technologically advanced, sort of moving forward the progress towards addressing that challenge. And then so I think you can think about additionality of the investment and the investee, but I also think have to think in public markets about applying these issues to the investor, albeit it's clearly less direct than in private markets or in sort of VC. And there, I think you have to think, and the impact management project, the IMP, look at a couple of different ways that public market investors can be impactful, whether it's signaling that impact matters or using your engagement to improve the impacts and the disclosure and the measurability of those impacts. So we try and think of those two things at both of those levels. And finally, in simple terms, I think the impact, a positive impact really is a positive change in outcomes for people or the planet. And I think the real subject for this discussion is, what is the investor role in driving that, in addition to the role of the underlying company in driving that?
Yes, yeah, they're two often quite different things, aren't they? Mike, would you like to pick up on that also?
Yeah, so I mean, impact's become a real buzzword, but in terms of how we view it is, our philosophy, along with probably many others in sustainable investment, is we're looking for companies whose products and services are going to get us much closer to a more sustainable development model than what we've got now, and that helps lead us to companies that are exposed to where we have 20 different quite specific investment themes about increasing, that all relate to increasing the efficiency of the resources that we use, improving our health, or making us safer, or the systems we rely on more resilient. And so that's where we get the lens through which we're trying to find these companies that are moving us in the right direction. But I think what's critical about this is that it's about how this actually guides the investment decisions ultimately. To what extent is that positive impact that company is having, be it by increasing penetration of renewables, or better resource efficiency, increasing recycling rates, etc. How much is that having how much has that got to do with you actually holding that company at all? And I think where some of the confusion lies is that you can dial that up or dial it down, and there might be things where there's much more of a focus on exactly what the outcomes are than other things where you might have some of your impact. I've heard it talked about more and more is through engagement, achieving positive change in the operations in a company, by engaging with that company to improve something that they're doing. I think that's almost sort of third derivative impact,
I think
but anyway,
dynamics been missed in this conversation so far, isn't it? Which is hugely important. But then now, I guess a lot of people in the industry today think of impact as being impact investment, whereas I guess you and I go back to pre-impact being a thing, because it hadn't made it across to our world. So we thought of it as being a more broader, investing in those companies that are having a positive impact. So the definitions kind of evolve over time. And I guess that's one of the things I try and explain to people quite a lot. Guess what? The wording around this stuff changes, but it's really good the way the GIN have come out with their statements, and people now do talk about, measurable and aiming to have specific outcomes and additionality and that kind of thing. It really helps create, a common language around it. But who knows where this will go in future. I suspect it will continue to evolve, either that or it'll get stodgy. And I don't think with those of us that are this keen on the subject involved, it's likely to get terribly stodgy anytime soon. I'm hoping. So can I then, just coming back also to Ben and Mike, I said I would touch on this one, and then that brings me to that point. An impact fund. Does a fund have to be called an impact fund in order to deliver a positive impact? Mike, would you want to pick up on that first, as you were just speaking?
Yeah, I mean, the answer is no. We don't have impact in our fund name. I like to think people are going to do a little bit more than just read the name of the fund. I think it's important that it's clearly communicated exactly what positive impacts that investment vehicle is trying to have. I think it's important that you've got people with experience and skills, and that might be through advisory committee or through people that have gone away and spent some time trying to learn about this. This is quite nuanced and it is evolving. There aren't really simple answers to all of these things. That's not to say it's not worth doing that work. But critically, I think it's about clear information and being really transparent about what you hold, in what way that has a benefit to society or the environment, and being very open to challenge if someone says, "What are you doing holding this company?" That you have a very clear response to that. So I don't think it needs to be called impact for it to have an impact. But I think those other things are important in working out whether that funds, the degree to which impact is included in the investment decision is satisfactory for you or not.
Absolutely, it's transparency as well, isn't it? Because even within impact funds, the strategies are going to vary. But so maybe I was being slightly naughty, pairing you up with Ben on this one. But I'm wondering if Ben might put a slightly different to it. We failed earlier. I tried to find some disagreement earlier, and I fell, at the first hurdle.
Okay.
But, if you've got differences here, that's a good thing, Ben. I'm happy.
Yeah. Okay. Well, maybe I'll say something slightly different, but I'm not sure if it's at odds with Mike, who I respect and trust, of course.
We all get on here
in many ways. One of the things I think what is important about an impact fund, whether it is in private markets or in the context of today's discussion, more in sort of secondary listed public markets, I think the fund has to really set out very clearly that it is an impact fund. I'm not saying non-impact funds cannot have positive outcomes, but very quickly I'm just saying I think an impact fund needs to set out very clearly its objectives as an impact fund. So when you set up a fund, I think you can have an ESG fund, or maybe even a sustainable themed fund might say, well, our primary goal is to deliver investment returns over the long term, but we'll do it by investing in these areas. I think an impact fund has to have an objective to address social and environmental challenges and try and contribute positive have positive impact on those challenges, as well as equal with the investment outcome. So I would say that is a sort of distinguishing factor, but that doesn't really answer directly the question, which is, can a non-impact fund have positive outcomes? I would say underlying investments within any fund can be positively impactful. And/or, of course, they can be negatively impactful. I think the thing about an impact fund, it is the whole fund is designed and is explicit about all the holdings having to specifically address social, environmental, socioeconomic challenges, where you have this net positive impact. So I would say you've got to draw a distinction, Julia, between funds which certainly may have positive impacts as well as negative impacts in them, versus an impact fund which is designed, and I think design is an important word here, designed and with an objective to focus explicitly and, let's say, entirely on companies that are addressing social and environmental challenges.
Okay, that's interesting. I'll give Mike a moment to come back on that just in case you want to add anything. But my take on that largely is the funds like Mike's and the ones that I used to be involved with. You know, they were designed at a different time, and that wording just didn't exist. And I think that's part of the dynamic there. Sorry, I can see Steve is wanting to come in as well. Please, Steve, go ahead.
Yeah, just piggybacking off of that, I think so. For us, the declaration of intent is what matters more than the name. Right? So there has to be a statement of intent that is clear and that basically links the strategy to this intention to drive positive change in at least some environmental or social dimensions. I think one element which is not necessary, but is probably good practice, in which investors should pay attention to when they're digging a little bit deeper, is how is that intention being implemented? And I would say that here, good practice, if you're going to incorporate environmental or social dimensions into your thought process, you probably should make sure that there's some environmental or social science backing the thought process. So, for example, in the context of our environmental strategies, we've incorporated the planetary boundaries framework, which was mentioned before, and which is a pretty broadly based, well accepted tool out of academia, out of the environmental science world. And so, you know, similarly in the social space, there's a lot of research, a lot of insights into social processes, and those ought to be incorporated if you really want to dig deep in
that's really good stuff. I like all that stuff a lot. Mike, I said I'd give you the opportunity to come back. Did you want to comment on anything that Ben had said a moment ago?
No, I think it's fine. If I was setting up a fund today and I wanted it to, you know, address what we're talking about, I'd probably lob impact in the title. But I think, you know, when our funds were set up, the intention was to make our clients decent investment returns by investing in companies that are helping us move to a more sustainable way. And we have a whole apparatus, how we measure that and ensure that, you know, more than a certain amount of each company is exposed to a theme before it gets into the fund, etc. So I think I don't want to go round and round this with Ben. I think it's fair enough if I had a new fund, but I think, you know, it is possible to have a fund that's doing everything that you would be doing today if you set up an impact fund that's been doing it using slightly different language for quite a long time.
Yeah, so I think part of, you know, what joins us is the use of really good information and the openness and transparency bit, which, you know, we've all got in common here, and my view is that is what differentiates all of us, all of you here on the panel, and my views on things from a lot of those funds who are really new to this area and jumped on it because it's an opportunity, and greenwash being the issue. We're going to come on to greenwash in the questions later on. So hopefully this will look like it's been put together with some thought. But Andrew, in the meantime, yes, I was going to come to you.
Well, no, I was just going to say, it was really interesting listening to everybody else. So, yeah, so I think you've got a great collection of very intentional investors on your panel today. You should always ask the question, if you took away the title, would you continue to invest in the way that you are today? And I've got a feeling that Mike, Ben, and Steve would all probably say yes to that. You know, so I think there is a danger in trying to play to the label rather than trying to play to what you believe your purpose as an investor is.
That's absolutely right. Yeah,
and I think that's really because having set up in my previous guise one of the first public market impact funds. I wanted to call it impactful, but I was told that grammatically that was a nightmare for marketing, because I thought it was a bit more truthful. But, you know, first we had to remember that first and foremost, our first job was to use it as a lens to be great global equity investors.
Yep.
And you know, that is something that is very important in this, you know, because as I said, in traditional impact investing, making a market rate of return wasn't a necessity. It was just a financial discipline. But when you go to public markets, it has to be that lens to help you do your job better and my evolution through ESG, sustainable impact, has been not that it narrows my opportunity set, but it actually broadens it, because it's really getting you thinking about where the world's going and all the opportunities that tackling underserved needs represents.
Yeah, thank you. Yes, good point. I'm going to let that flow then through to the next question a bit, because I've got you up first on that anyway, Andrew, which is then, so how useful is impact measurement in that? Where does measuring positive impacts fit with defining and identifying those benefits? So I'll come to Andrew and then Steve on that, if I may.
Yeah, look, I think measurement is important, but I think there's a danger of overcommitting to measurement and trying to put too precise a value on many of these, what would be seen as more holistic returns. You know, so take something like a quality job. A quality job in Detroit, Doncaster, Delhi, and Dar es Salaam are all needed, but the dollar value that you put on them and how you look at them are very different. And then how you actually add up different impacts over completely different dimensions as well. So I think sometimes I think people overstrive to measure everything, and they sometimes forget that the narrative, particularly in relating to clients, is as important, if not more important, than the number. I think also, when you come back to the notion of greenwashing, we need to be very careful with measurement, that we're actually measuring something that is clearly observable, that the company can report as well. So, when I was looking at impact before, I've always been reluctant to do estimated impact. If the company can't report it, then how can you know better than the company? So, for me, that's, let's use numbers where they can be verified and they're substantiated, but let's not try to put a number to everything, because I think sometimes that removes some of the real heart of impact investing.
Absolutely, I totally agree. So I mentioned, you may not have heard it, but I quoted someone I heard recently talking about heroic assumptions being made by some asset managers in this area, and that wasn't necessarily meant in a kind way. I don't know if that's a sentiment you'll all agree with, but so Andrew, Steve, if I can come on to you, do you have comments about impact measurement that you can add to this?
Yeah, well, I think it is essential. I mean, as mentioned before, it is part of the value proposition of impact investing, that you're going to be accountable, or at least do your best to be accountable. And I do agree, it's a very messy area, right? It's the financial accountability is easy. The impact accountability is a difficult one. I do think it's a space where the fact that we are now applying impact concepts to broader pools of assets also means that we can invest more in research and development around these things. We've seen that in the private market space, with the bigger players coming in and devoting a lot more resources, and the same thing can be said for the listed market area. So again, I think ultimately we're definitely not at the place we need to be, but I think it's an interesting trajectory we're on. And again, I would say you need to embed scientific methodologies, whether you're focusing on the environment or on the social side of things, and ideally use the same frameworks for decision making and for reporting. That's basically the way you can be the most transparent about what you do and what you've actually achieved.
Thank you. Yes. I think hopefully that blends us more or less into the area of greenwash. So when we're talking about openness and transparency and what we can and can't measure, etc., I'm going to ask Mike and Ben to pick up on the question then of, when you're looking at this, at what point does it look like you're moving across into greenwash? And can you, based on both your experiences, because you both know so much about this area, can you talk about what intermediaries ought to be looking out for, please? Who do I start with? I don't know. Ben, let's start with you.
Yeah, sure. Well, I think the previous discussion does exactly blend into this discussion, Julia. So I think, one of the reasons that measurement and measurability is so important in impact as well as in other areas, I think, is it forces you as an investor to really kind of do it properly, to really analyze and understand the positive impacts, and then sort of counterbalanced by any maybe negative impacts. Think about questions around materiality, i.e. not just say this is a company where only 5-10% of its revenues are going towards this positive impact area, this sustainability theme or challenge, and calling that a positive impact company, but actually really drilling into companies that are generating a significant proportion of, if not the significant majority of their revenues from a solutions area. And so I think you've got the importance of or the mechanism of transparency is incredibly powerful, and it actually helps you as an investor to understand the drivers of the business and its opportunities as well as its risks from an investment point of view, as well as actually from a kind of sustainability and socioeconomic and impact perspective. So I think it's an incredibly important and value enhancing approach, this focus on measurability. Clearly, it's not always possible to do it perfectly, and I do think the endeavor to try and do it as well as you can is important, with a view that actually sometimes you can engage with the company. In fact, you do need to engage with the company to improve their measurability, to improve their disclosures. And I think so it's really important, and I think it protects against the greenwashing question. So I think as an investor, at the company level, if we think a company is just providing nice PR rather than telling us how purpose is really embedded in its core strategy and all the drivers behind the business, for us, that's a warning sign about greenwashing at the company level. Similarly, from an investor point of view, shining the spotlight on ourselves, I think we need to be held accountable to our clients and our customers. We need to be very transparent and clear about the approach we're taking, the areas we're focusing on, and being able to try and measure the impacts our funds are having. So I think that transparency is the best pushback against criticisms of greenwashing. So I think if you're not transparent and you don't do as good a job as you can on measuring, then I think you're falling foul of probably of accusations of greenwashing. And the final thing I'd quickly say would be that I think that there are mechanisms and there are tools that investors can now adopt to help us understand the impacts in our funds, to get a second opinion on our own analysis. And I would say also kind of producing impact reporting for an impact fund is a prerequisite in living up to the sort of contract that we have with our customers who are investing in impact funds. So yeah, I'll pause there, Julia.
Yeah. Thank you. Yes. I was going to throw this one to you, Ben, but given time, I'm going to pass it to Mike, and I know he'll enjoy this. There's a comment come in linked to this, one word, Nestle, from Rebecca Kalowski. Well, that's not the right pronunciation at all. Anyway, Rebecca. So in the context of greenwash and impact and what are the warning signs, you might want to touch on what you look for possibly in that context, Mike?
Yeah, I mean, to answer that question, one word, Nestle. Can companies that are that huge and so potentially harmful ever make enough meaningful action to offset their negative impact? I mean, the quick answer for us is we don't hold Nestle, and so clearly we don't think that they're a particularly interesting company in terms of sustainability, in terms of the trends that are going on. That's not to say that every other sustainable fund has the same view. They might view it that there are some positives, and that actually there are maybe some areas that they're doing particularly well, maybe in reducing water use or etc. So again, this is why it's so important to check. I suppose the biggest sanity check for Greenwash, etc., is to get a list of all the company holdings, all the fund holdings, all of them, not just the top 10, and just have a look and see what you feel about it. If you can't get a list of all the holdings in that fund, move on to one that you can, because that in itself is a massive red flag. You should be able to see everything that's in that fund. Not only that, if you happen to see Nestle on there, you should feel that you can write to the fund manager and ask them to explain why they think Nestle is, a suitable company for that fund. And they should have very good reasons as to why that is. They should have thought about that a lot. And I guess that's one way of and you can really base it on, I don't think there's a right or wrong way about whether you hold Nestle or not. We could debate that, but if you want, but but what's more important is why are you holding Nestle, and what are you talking to Nestle about? You know, is there something that we don't know about it? Because quite often end investors are basing their information on something they read when, I don't know, they're at university 30 years ago. And, you know, these companies do change and things do happen. So I would say that's really critical to that transparency and being able to challenge the fund manager on what's in there. And I'm not talking about a marketing department sending you a bland email and a link to a PDF that says, because it meets with our criteria, please find attached. I mean, a proper thing. We like Nestle because whatever you like Nestle. I don't know. It's
So, I mean, likewise, there was an example in the earlier panel about Tesco's, and I always laugh because in my past, we just had endless complaints about Tesco's being held as an investment. And in fact, they didn't want to talk to us. You know, they refused to speak to responsible investors. And now they're doing loads of really good stuff, and they're being used as a case study for, you know, how things should be done. So, you know, companies have got to be given room to improve, and that's where the kind of where do you draw the line bits gets really interesting, and why why we've got so many different filter options on Fund EcoMarket, because everyone's got so many different strategies, which is what makes the area so fascinating. But did anyone want to come in? Sorry, thank you, Andrew.
Yeah, no, I was just going to pick up on something you said earlier, because you said all companies have impacts. And I think, you know, Nestle or any large company is a good example of that. If we actually really want to transition to a truly sustainable system, I always think sustainability is something we seek to achieve in the future. Because if we think of it as something we're achieving now, then we're missing the point, because the whole system needs to transition. And it's got to be companies like Nestle that actually really learn to get it. It doesn't mean they are a sustainable company at the moment, but if we really want to achieve a truly balanced environment, then it's these large companies that supply things that we buy day to day, you know. So it's very easy to say Nestle is not a sustainable business and then go out and do your shopping and buy, you know, a large number of products from them. So there has to be some concept about how do we help, encourage, and, you know, engagement is an important part in that. But we really do need to think about how these companies are going to transition. And that's why I think it's really important, as Mike said, to really drill down into understanding your theory of change that applies to these companies and how they can play their part. You know, and it's not just about what they tell you. So looking at, you know, Unilever is equally as challenged with palm oil, one of the worst uses of single-use plastics in the food industry. You know, being a business like that inevitably comes with negative consequences and challenges. And then it's just about the question of how that is being addressed, and ideally a future plan with milestones along the way for how they're actually going to transition to a more sustainable system.
Absolutely, and I think that's picked up on what was the next question, which is if current practices continue, in your view, is that a risk? And that's talking about the journey that people have got to go on. And did you want? We've only got a couple of moments left, so can I ask if you wanted to add anything on that, Andrew? Now, if I can move to Steve.
Well, just very quickly, I would say, you know, a really important part of the future of ESG is not to make it a label or a score. You know, it's so important that it has to be seen as a journey to something that is attained in the future. You know, we've mentioned planetary boundaries and the science. You know, the system is in net deficit at the moment when you look at it overall. And so therefore it's thinking always about how we attain a better outcome in the future, rather than just playing to a current set of labels and status. There's no point, you know, being great at ESG if you're in a degenerative system. You know, they're going to be the fittest person in the hospice. It's not a good outcome at the end.
That's a great comment. Sorry, that's so unfunny in the current climate, but yes, I love it. Steve, would you like to come in on that also, please?
So on the current practices, maybe just adding one element which we haven't discussed, and that is relevant for the impact space today, and it's basically the Sustainable Development Goals, which really for the last 2 years have now emerged as a framework for reporting, which in a way, it's a good thing because they're broadly shared goals, but at the same time, this is a framework that was not meant for investors, and it's creating a lot of confusion at the moment. And so where greenwashing is happening, I think to an important extent, it's in this SDG reporting, because to some degree it's based on whatever the companies flag in their brochures. To some degree, it may be the methods may be very unilateral, so maybe focusing just on positive outcomes and not the negative. And so we've chosen to show some SDG mapping of our portfolios. We were reluctant to do that, but it's really a response to demand. But we're being very transparent that it's just mapping. We're not calling that impact. And I'm seeing a lot of conflation of the SDGs with impact, when in fact the underlying methodologies often don't really allow you to make that link.
Thank you. I think that's a really good point. I think fund managers have been pushed into doing that to some extent. I hear that quite regularly, because the SDG is becoming a thing in investment. But anyway, that's the impact greenwash trade-off, and then trying to get a balance somewhere between the two. So could I ask you all now, please, just really in a couple of sentences to say not only your closing remarks, but also what do you expect to see changing if you can? Who shall I start off with there? Steve, shall I start off with you as you just finished?
I'll just reiterate the points from before, that I think as more capital is moving into impact in listed markets, I would expect to see more investments in methodologies and really, research and development with respect to impact measurements and reporting. If it doesn't happen, then we are in trouble. Then this will remain a very fuzzy discipline. If it does, then we can actually mobilize capital to change things for the better.
Let's hope so. Thank you, Steve. Andrew?
I'd just sum up by saying, look, sustainability is no longer an option, it's an imperative. And, I think our role, and, I think the people on this panel have exemplified it well, is to try and navigate our clients through a world in flux. The world's changing in ways it's never done before. And sustainable investment is about investing in the future set of opportunities. And for me, that's why it's still so exciting after 30 odd years in the investment industry.
Yep. And Ben, can I come to you next, please?
Yeah, sure. Well, so I think one of the real, the reasons for doing impact investing is to try and address those SDGs, those global challenges that Steve mentions. Whether it's the right framework for measuring and defining impact is a big question, which we won't answer right now. But I think the goals are there. They represent challenges that investors need to address. And I think what is really interesting about the kind of COVID period and longer term as well is that clearly progress towards the goals, which was sort of sparse and patchy before the pandemic hit, that progress has been massively set back. The SDG funding gap is enormous. So I think we do need, as was previously said, to direct capital in that more sustainable direction towards the solutions, rather than just thinking about a do no harm perspective around exclusion. So I think impact investing has a massive role to play. We need to make sure it's done properly. We need to kind of get the definitions and the language right. We need to avoid greenwashing, of course, but I think the whole of the investment chain needs to navigate towards more impactful investing, because we're way behind schedule on addressing the SDGs. And it's, as Andrew said, it's an imperative rather than just a sort of, nice to have. It's an imperative, but it's also a huge investment opportunity, because we think companies that are providing the solutions over the next 5-10 years and beyond will actually be the companies that will thrive in the new economy. So let's shift everything in that direction.
Thank you. Yes, no, here. Mike, and can I ask you to finish with this one, please?
Yeah, I think that investor demand to understand more about the impacts is only going to increase. I think this is going to be a rapidly moving area. I think you can expect to see more and more disclosure and more methodologies coming out to try and answer that question. If I invest £1,000 in this fund, where is that being invested in? What are those companies doing? And also, what's the fund manager? What's the quality of that conversation the fund manager is having with them to perhaps address some of the negative externalities that are coming out of that business? So yeah, I think this will continue to evolve, and although it's tricky, it's worth doing.
Yeah, well, one of my favourite phrases, look under the bonnet. Don't go just by what something's called, look at what they're actually doing. Go for the transparency, find out, understand the strategy. I'm going to have to close there. We're running a little bit over. This is the first time all day I'm running late. But I meant to say at the beginning, each of you could have talked on this easily for the whole panel length. I know that. And I'm sorry for bringing such a load of great people together to just fire questions at you. I'm going to finish on one point, though, which is from Rebecca, who asked about Nestle. Brilliant answer to my question. Thank you. And by the way, she did write to the fund manager, just so you know. So I thought I'd pass that on. So I really appreciate you all spending your time.